All right, everyone, welcome back to another video. I know it's been a while. Happy New Year. Happy 2022. Please do subscribe if you have not already. I really do appreciate it. Thank you for watching any and all of my videos. And let's get right into this one. This is Uber. So they go by Uber Technologies, obviously. They're actually a lot more than just a ride-hailing platform. They do delivery, they do freight, they do a ton of other things. And so they've kind of diversified themselves in their space. And as you can see, they have a strong buy rating. Out of about 20 ratings, 19 are listed as buy, and they have a $69 price target, which is a 60% upside from today. January 6th, 2022. So that's pretty good. And their stock analysis says that they are a 6. That's not very good. I usually only consider stocks that are 7s and above, but I think that there still needs to be a lot more done on Uber and where it can go. I don't think it's anywhere close to its potential. So we'll see what happens there. Let's look at their income statement, where obviously in 2020 they had a pretty large gap down because of the pandemic. Ride share drivers were in short demand. There weren't that many of them, and there weren't that many rides because no one wanted to get a ride in a car with someone that was sick, potentially could get them sick, and was just, you don't know who that person is. No one wants to get in a car with a stranger and have them drive you around with the potential of getting sick. So there weren't that many drivers, and there really weren't that many needs for a ride. So revenue dipped from 2019 to 2020. And then also we can see that they've never been profitable. I don't think that this 987 is a real number. Uber did go public in 2019, so I don't think that is true. But obviously, it is good to see that even though their revenue was down in 2020, so was their net income grew, so it became smaller, which is good. When it's a negative, negatives become smaller. That's good. So that's really good to see. And if we actually look at their balance sheet, we can see that again, I think that they had to spend obviously $5 billion to keep the business afloat and keep it going as long as possible. I don't think that they really had much to kind of keep them afloat because now that they're a public company, it's either you take out loans from banks or you go under. And I don't think that they wanted to go under, so they decided to go with the former, not the latter. They didn't want to go under, so they took out loans. And as you can see, that did go from total current assets of 9.8 billion to total current liabilities of 6.8 billion, and that's good. They still have positive working capital. Total assets is about 33 billion. Total liabilities is about 19 billion. That's pretty good. Someone is doing a good job here. Obviously, they had to take out some more long-term debt. They issued more long-term debt, and I think they also, well, we can see it on the cash flow statement. We can see if they have a lot in shares issued too. So we'll see. Let's look at the cash flow statement, where we will notice that, scroll down, yeah, they had 1.4 billion in acquisitions in 2020, and they also, it looks like, yeah, here's that 2.6 billion in long-term debt issued. They repaid about 751 million. That's about a 1.9 billion dollar net change. And yeah, they really didn't actually issue any new shares, and they didn't really rebuy any shares either. Obviously, they in 2019 they issued about 8.9 billion in equity because that's when they went public. But other than that, and it actually took them a long time. I think it took them close to 10 years. They were actually being pushed out the door to be public by their investors because they're coming up on the 10-year mark, where basically your investment becomes zero if you don't get it out the door after 10 years. So either way, that's pretty good. That they actually didn't issue any more new shares in 2020. It was basically all the shares outstanding. They did no repurchases because they didn't have the money to. Really, they had to just keep the business afloat, so they used $5 billion, and they issued a little bit more, about 1.9 in long-term debt. So that all makes sense. And let's now look at a portfolio of Uber. Uber, like I said, had IPO'd in June of 2019, but the data that we have for this portfolio analysis is from January 2020, so about 6 months later to 2020. And basically, if you had invested $10,000 as of December 2021, so about 2 years, you would have about $14,000. So you would have about a $4,000 gain. That's about an 18% compound annual growth rate. Not too bad. That's not the worst. Honestly, that's not the worst thing that could have happened. Again, annual returns, they had a great 2020, and then they also have had a poor 2021. I think that they're just trying to find their way out of the pandemic and where do they fit. So, hope you guys like this video. It was quicker, and I'll see you next time.